Welcome everyone to another episode of Financial 15. Kevin and I are ready to go provide some more knowledge, hopefully improve your finances, do all of it in 15 minutes or less. And today we're going to be talking about how to avoid probate tax. Should you be using a joint account? Is that the right purpose? We'll go through the good, the bad, the ugly. We'll cover it all about joint accounts.
Yeah, something that everybody seems to think is a really simple situation to deal with joint ownership. It's not. There's good, there's bad, there's ugly. You need to know all the pitfalls, all the points, and everything that can go on with it. So if you want to find this video or anything else that we've discussed in the last little while, please visit us at our website at beckerorr.com, or you can go to our YouTube channel or like us on Facebook, find everything you need content-wise there. Clint, what is a joint account? How does it work? What are we going to do with it?
Yeah, that was a good starting point. What is joint ownership? There's different types of joint ownership, and we'll get into the two different types. So I'll start with tenants in common. That's where each owner, they hold their own ownership interest in the assets. So let's assume here we got a cottage. I own it, say, with my brother. We're tenants in common. That means when I pass away, my portion of the cottage can go through my will to my spouse, for example, or someone else. It doesn't automatically go to my brother. My interest can be bequeathed to somebody else. That's different, however, Kevin, joint with the rights or survivorship, right? Key difference between the two. What's with the rights or survivorship? How is it different?
Yeah, with the rights to survivorship, basically what you're doing is it's a joint asset owned by the two parties in there as it is, and the right of ownership transfers automatically to the other party. So if you have, say, a joint bank account and the money's been set up to go in there, if one spouse passes away, let's assume there's two spouses there, all that money automatically goes to the other spouse. It is not tenants in common with each separate interest. One goes to the other, and that's the sort of scenario, so that the assets pass outside upon death, outside the deceased's estate, as opposed to being included into them.
Yeah. So in the example I use, my brother in a cottage, tenants in common, my share could be going through my wills. My interest could stay within my family. If it's joint with the rights of survivorship, when I pass away, my share automatically goes to my brother, automatically goes to the other owner. Well, let's get into that one, joints with rights or survivorship, because that's the one folks often use to avoid probate tax. It's often used in estate planning. We'll go through the good, the bad, the ugly. Kevin, start us off here with the good, with the joint ownership.
Yeah, basically, I mean, a lot of the reason that this has been done, it's become an estate planning scenario so that you can avoid getting things out and the ease of transfer. By having joint ownership, one thing that we do mention is it can be and or. You can have joint ownership where it's or, which means either one of the parties can sign on something, or and both parties need to be included with dealing with that. But ease of asset transfer is the biggest one. This is what we want to do. So you're setting up an investment account, you're setting up a bank account, things along those lines, or maybe even home ownership. The reason is that you want it to pass to that other party without having to deal with the hassles that are legal and administrative, without the probates or anything else along those lines. So ease of transfer there. As we mentioned below, bypassing probate. Now, probate needs to be done usually if an estate's dealt with, depending on how things are gone. If you have a whole bunch of assets that are joint, though, you can bypass this process. That way you don't have to worry about it. It automatically transfers over to the other party because you've set it up that way as a joint ownership scenario. So no probate, no estate administrative fees. You're saving yourself some costs. These are some of the good reasons and some of the points to do it. And a lot of times it's usually done between spouses so that you can avoid that sort of scenario. But that's not just it. Besides the good, there's also other points, isn't there?
We'll get through the bad, we'll get through the ugly, but quickly on the probate, let's expand there so folks can really see the details. So avoiding probate, one of the key reasons why folks might use that joint with rights or survivorship when it comes to their assets. And what are the probate fees? Well, it varies based on province. So we're doing this in summer of 2021. These were the current rates at the time. And you can see some provinces like Alberta, they have a flat fee. It's just a couple $100 and that's it. Others have a percentage, like BC, for example, 1.4%. So the larger the estate, the more you pay. And it does vary by province. Manitoba, will note last summer, Manitoba got rid of probate fees. They waived them. So right now in Manitoba, if you have to go through the probate process, there's no cost. So joint ownership, not joint ownership, won't make much of a difference. But you can see other provinces, the fees can be larger, especially the ones that have a larger percentage, because then as the estate size grows, those costs will also grow. So you can see probate there, Kevin, varies depending on where you are. It can be a couple $100, or Manitoba, no cost at all, or in other provinces can be a larger expense. This is usually one of the key reasons why folks will use joint ownership, to avoid these probate fees. So that's the key there on probate. We talked about the good. Let's get into the bad here, Kevin. It's not always so simple, is it, joint ownership? There can be some
No.
complications. Let's start with the tax implications. Walk us through those.
Yeah, okay. So we'll start with some of these first. I mean, real estate, as we've mentioned up top, is one. If you joint the ownership between you and, say, your child, and the child already has a residence, well, now you get to worry about the principal residence exemption. That's a big thing. We know that individuals can have a home, and if they sell that home, once it's sold, they don't have to worry about the tax consequences on it. But if now your ownership is joint, and say your child has a principal residence as well, portion of this may not be able to be claimed for that. So that's a very important tax implication a lot of people don't consider when they want to put joint ownership that way. Same sort of things can happen with an investment account. That's another one that we have to take a look at, where tax slips, depending on where it's gone. Let's assume that you joint up with your child, but you've had this account for a long time. Now, all of a sudden, CRI could come back and require attribution of income depending on what's gone on. So if you contributed most of the capital, as opposed to being able to split this equally, there may be something down the road that you have to pay more on depending on what it is going from there. That's one of the points. The other thing is that you may trigger a capital gain. Capital gain may happen because if you had an account that had 100,000 and then you wanted to put somebody else's name on it with you, that's deemed to have changed ownership completely. It's gone from a single name now to a joint name. There is capital gains automatically triggered to do that. And people sometimes don't realize that that's a possibility or what happens with those things. But tax implications aren't the only thing. There's more to the bad, isn't there, Clint?
Yeah, the loss of control. We have to remember, you're not just simply adding someone's name to the account. You can't just throw your kid's name on your investment account. It is a joint owner. They will have ownership and some say in what happens with those assets, which means they could be making some of the decisions. For example, instead of an investment account, let's imagine it's a property. Well, decisions regarding maintenance, renovation, sales, those now have to be jointly made. You can't just sell the cottage without their consent. And for those financial accounts, the investment accounts, the joint owner would be able to withdraw money. If they set up a joint account and you put your kid's name on there and the kid calls up the investment firm, they would be able to make a request to take some of the money out. So you have to keep that in mind. You're not just simply adding a name to an account or adding a name to a property. You're giving ownership. You're giving decision-making authority. You're losing some of the control over those assets. Now, that's just going through some of the negatives. It can get quite ugly. We got the good, the bad. Let's get into the worst of the worst here, Kevin. The ugly part of joint ownership when things simply don't go according to plan. And we'll start with the equalization issues. Why don't you look at those?
Yeah, basically that's where it becomes. So, a large portion of the assets that are held jointly outside an estate, if you've got so much stuff that's been done in joint ownership and it avoids the estate, when the estate comes due and they have to pay their taxes and everything else that are owed on what the assets are that are in there, there may not be enough money in there to do that. So without the sufficient assets, some of these legacies that they may want to fund or some of the excess cash that may be going to someone else outlined in the will not be able to happen. And the reason is there's not enough money in there to do that. So that's one of the aspects that goes on with estate equalization. It is a nice way to try and avoid probate, but by the same token, you have to worry about the end result, what's going to go on. So the desired distribution of the estate, as we mentioned, may not meet what the jointly held assets or legal action can do. But that's not the only ugly thing, is it?
Yeah, I mean, you could have legal action in that case, what you just described. If not all the assets are there, maybe the other parties that are beneficiaries of the estate are upset with the distribution. They can take legal action. And then also, when you add a joint owner, you're exposing yourself to all the pros and cons of that owner. Maybe they're a great individual, or perhaps they've had some financial issues and they're in bankruptcy, or there's creditors, or maybe they get a divorced and now there's going to be an ex-spouse and maybe a matrimonial claim on that asset. So when you add a joint owner, you're exposing yourself to all the credit situations, all the potential divorces, anything that person goes through. They now have a chunk of that asset, so they could get wrapped up in those type of claims. So you might think you're saving yourself some costs, saving yourself some probate, and in the end, you could end up in a tricky legal battle there involving your assets. So it's not quite as simple. There's definitely some benefits, but you can't just slap a name on an account or on a property and hope it goes well. We always tell folks, get some assistance, talk to an accountant, talk to a lawyer, financial advisor, but you want to make sure you're doing it as part of an overall estate plan and that it actually makes sense, and you'll get more of the good and avoid some of the bad and some of the ugly.
Yeah, you're exactly right. I mean, joint ownership sounds like such a simple thing. Oh, I just want to put a name on there and that way I've covered everything else. But as we've mentioned through these points, it's not that simple. And you're right. I mean, you do need to consult people before you do it. It is not the simplest or not the easiest thing in the world to go through. And again, you got to know what all the consequences are that are going to deal with your estate, with your taxes and everything else. So yeah, I mean, it's something that please look at this. If you have questions on it, by all means, feel free to get in touch with us at any time. Chat with Clinton and Kevin down below, as you can see, on this topic or anything else, whether it's related to probate, whether it's related to anything in regard to specific accounts or properties that you're dealing with. We're more than happy to answer any of those questions. Other than that, I'm finished with what I have to say. Final points, Clint?
I think we covered it all. So we appreciate everyone tuning in. We'll be back again soon with another video. Take care.